welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us at the MarketSite studio in Times Square, New York City, Nelson Chu is back with us. He's a co-founder and CEO of Percent. We're going to get his outlook on the private markets for 2023 and why modernizing the private credit markets to bring it up to public market standards is really key to advancing that. It is great to see you as always, Nelson. Welcome back to Trade Talks.
Thanks so much for having me. Always good to see you.
All right, with Percent, your outlook, all the data that you collect, why do you think 2023 will be ripe for private markets?
Yeah, so obviously pressures on the economy, that is for sure, right? But that doesn't mean that all assets perform equally poorly. I think there's actually a lot of opportunities there. And when you think about sort of the difference in private markets, specifically on the equity versus the debt side, we can kind of break down each of those individually. On the equity side, startups have been repriced, right? And so valuations have come down dramatically. But it is a bit of a return to normalcy in some respects. And so there is almost an opportunity to actually have and invest in companies that are trading at valuations they can live up to, which was not the case before, right? So this reversion to the mean or the norm and historicals is a good thing for the industry as a whole. Debt is a little bit different, right? And so on the debt side, there is almost like a real-time reaction to the markets in many respects. And so you're seeing the opportunity where a lot of these companies that raise exorbitant amounts of debt, exorbitant amounts of equity to kind of balance that out, are getting washed out because they just can't perform and build a sustainable business coming out of that. And so what's left is a bunch of startups and a bunch of debt opportunities that are actually incredibly good. And so we're fairly confident, we're actually very optimistic about finding these diamonds in the rough. And on top of that, there's actually a need to deploy capital from investors because they can't sit on the sidelines. The risk-free rate is so high right now that to compete against their peers, if they have a bunch of undeployed capital, they have to put it to work. And so that's going to go into private markets is our expectation. And by reverting back to the mean, there'll be an opportunity for these investors to do really well for themselves. And the fact that private markets are so opaque and so illiquid means there's a lot of mispricing going on, and so you're going to be able to find really good opportunities to do really well as an investor.
And we're going to get into that in a moment here, but everyone's talking about that it's a VC winter, right? How do you think this will affect investors for this year coming up, including borrowers and underwriters?
Yeah, so if you think about it, like, we're in a situation where, yes, obviously investors have taken the brunt of the downside that's happened in 2022, and they're trying to figure out what to do, right? So LPs who are investors in VC funds, they've been slow to commit and meet capital calls. That has a downstream impact, right? Startups who are looking to raise money have VCs who can't always deploy on time, and so there is a lot of dynamics there. But if you look back at vintages of 08, 09 for VC, that was their best vintage ever. Because the reality is, if you're willing to put money to work in this environment, you're going to ensure that whatever company you back is going to survive, right? And so that is going to be really good for the startups who can raise in this environment and can raise from investors. On the debt side, going back to that kind of equity versus debt split in private markets, that has to, again, react in real time. And so the debt markets never stay frozen for long. There's always some sort of market seizing up, and then rates come back and they figure out what is the best market clearing price. And the reality is, for the right price, there's always somebody who's willing to take it, right? And so you're seeing this right now. The bond market issued $600 billion in this year so far. We're like 2.5 weeks into the year at this point. That's a stark contrast from 2022, where there was a 78% decline in year-over-year issuance volume for the high yield market versus 2021. That's crazy, right? So people are coming back to the bond market, and that bodes really well. The problem with, to your question around borrowers, it's kind of it's an investor market, right? So borrowers have to deal with it ultimately. And so they are price takers no matter what happens. And the reality is in this market, with the risk-free rate where it is, they're going to have to deal with a higher price. That's going to be the new normal for them. And the ones who can make it will do really well for themselves. But private markets inherently, based on their structure, forces the borrowers to come back out to market and deal with whatever price they have to deal with at that point in time.
Right, but to your point earlier, it feels as if this valuation reset was needed. We kind of go through this every 10, 15 years or so. And there's a number of reasons, right? By the time these companies come public, you certainly don't want the public investors to be the ones stuck holding the bag and being afraid to invest in these companies in the public market. They certainly want an opportunity. But the liquidity is out of the system that we've become very accustomed to, certainly over the past 10 to 12 years. And this could be inexpensive, but a great learning opportunity for these companies deploying capital, and of course for the startup management teams to really learn a good lesson here.
They're going to have to hunker down and learn how to build a profitable company. And honestly, as a company, your business and vision should be to be profitable. It shouldn't be to just have an endless money machine pumping you up and helping you kind of get to where you need to go. So it's a good thing for the system. It's a good thing for the debt markets. And honestly, private credit emerged out of the global financial crisis. Like, it has thrived in light of all of that. And so we expect the same thing here today. It'll be painful. It's not going to be easy.
Right.
But the ones who do well will do very, very well.
Right, and speaking of not being easy, your mission at Percent is to modernize the private credit markets, and you mentioned earlier these are very opaque. So what does that entail? What are you trying to do to make it mirror public markets?
Yeah, I wouldn't wish this journey upon anybody. Actually, it is a incredibly difficult endeavor, but we've been at it for 4 years at this point, and I think we've come a long way, right? And so we've had a lot of the benefit of, I think, fintech infrastructure maturing enough to the point where we can stand on their shoulders to be able to deliver a lot of these things. So things like real-time data, things like being able to actually verify identities and compliance checks and things like that around customers has helped make our lives a lot easier and has helped transform the private credit market for the better in terms of just pure using technology to be better underwriters, better lenders, and all that stuff. So that's all good. And so assuming that the tech is there, the data is there, and all of that is kind of very cost effective, it just comes down to what can we as a player do to create market standards for the industry? Similar to the way the high yield market did in the 80s, we're trying to create that same thing here, and we've done it ourselves, right? So over the past 4 years, we've underwritten $1 billion worth of loans and financings and ABS transactions. It's across 390 transactions. It's been an absolutely crazy pace. And we've had a lot of people in the market be like, how are they doing this? Like, this is crazy, right, this pace. And so they're asking if they can do it as Percent, can we do it as well? And so we've been able to actually get a lot of inbounds from partners who are recognizing this and saying, yeah, I want to take advantage of the tech that you've built here today. And so that has worked out really well for us. This is by far the most exciting year of the company's life. We've opened up the market. Now all three sides, to what you asked earlier about borrowers, underwriters, and investors, can now transact on their own on our platform, and it's leading to a lot of good conversations. Actually, last week we announced a partnership with Nomura, right? And so,
Oh, wow.
yeah, so they came on and said, yeah, we really like what you're doing. We love to explore syndicating venture debt positions out to your marketplace. And so that's, I think, a sign of things to come. It's tier one validation from the sell side, and it couldn't have come at a better time because private credit has so much interest right now.
Well, not even that, but 2022, which is such a challenging year to be able to execute, is really quite remarkable. Now, from an investor perspective, what does that mean? Does it mean anything for the retail investor? Does it help portfolio managers pick their investments more effectively? What does it mean for us?
Yeah, absolutely. So I think the core thesis for us at the end of the day as a company and as a mission and vision is transparency, right? So if I can give you more transparent data around real-time performance, around the structures of the deals themselves, all the things that we come to expect as almost like table stakes in public markets, in public bond issuances, and just all those things that you can find on a Bloomberg terminal or anything like that. If we can bring that for the very opaque, very illiquid private markets, you should have better pricing, you should have better understanding of whether you want to invest in a transaction or not. All of those things are helping to make for a more efficient, more vibrant, and more standardized marketplace that we take for granted everywhere else, that we're going to kind of bring here, and it's going to be transformational for a multi-trillion-dollar industry.
All right, Nelson, we appreciate the insight as always. Thanks for joining us on
Thanks
Trade
so much
Talks.
for having me.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.